Welcome to Nasdaq TradeTalks. I'm your host, Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for this segment, we have Russell Rhoads, Associate Clinical Professor of Finance at Indiana University. We're here to discuss why VIX is at an inflection point and what that signals to the market. Russell, it's great to see you as always. Welcome back to Trade Talks. And really, that's the conversation these days, right? When will we expect to see a return to normalized volatility, or can we expect more as we move forward through negotiations on multiple fronts?
Is telling us we don't know right now. So basically what it's saying is what we're looking at is we've got VIX in the low 20s, but we have all of the futures contracts based on VIX in about a 50-cent range. And I know people often look at VIX only when it's elevated, so they're used to seeing the index higher than the futures. But in a normal volatility environment or in a low volatility environment, we have the index and then we go up over time. And that's typically because there's a risk premium involved in being short volatility. If VIX is at a lower type of level, then people that would be shorting the VIX futures deserve some sort of cushion in there. When VIX spikes up, typically VIX futures traders are very aware that VIX usually does not stay at elevated levels. In fact, it's only stayed above 30 10 days in a row a dozen times since we've had VIX. Typically, VIX goes up and comes back down very quickly. But sometimes when VIX goes up and then comes back down, it kind of stalls out. And the futures the futures traders seem to be a bit clueless as to what the next direction is going to be. And we end up seeing a really major inflection point with respect to the stock market. And unfortunately, and this is where I get a lot of negative pushback, it's volatility in one direction or another, not necessarily directional volatility. Either we get a huge rebound up and then VIX goes back into the contango shape, or we get and when I say rebound up, I mean in the equity market, or we have equity sell off and VIX goes back up and we go back into backwardation. So I think even though there's only one critical news item this week in the FOMC, this is a pretty critical week for the stock market, really for the next 3, 4, 5 months.
Yeah, and it's interesting that you bring that up because, volatility can mean going up or going down. So sometimes I think, not that it's disingenuous, but calling the VIX the fear gauge or labeling it as such isn't necessarily reflective of the mechanics behind it.
Well, absolutely. And the mechanics behind it, this is one of the things I get real excited to teach in derivatives classes, finance classes, is that upside volatility contributes the same as downside volatility when you're looking at realized volatility. And the mechanics of the VIX is mostly constructed using, or most of the option volume that feeds into the VIX calculation is S&P 500 put options. So typically when we see increased demand for S&P 500 put options, that pushes VIX higher, and that's where we get the inverse relationship with the S&P 500. However, in cases where the market has sold off, it's starting to work its way back, maybe market participants are not as keen on hedging. They just had a hedge pay off. Also, the hedges are a bit expensive. There's just an awful lot of uncertainty in the overall market, and you really can't look at VIX in a vacuum. It is a fear index when it spikes up to 30 or so, but you really need to take a look at VIX and then take a look at the futures market, which give us an indication where traders think VIX is going to move. Right now, it's a coin toss according to the futures, higher or lower.
Well, I guess the real fear gauge is whether you're long or short vol at the end of the day. Let's take a look at different markets here and see what you can isolate on the index level. Nasdaq 100 more volatile than SPX and the Russell on a relative and absolute basis. What's significant about that?
Is we the FOMC this week, which I mentioned at the beginning because I knew we were going to talk about this part. And the FOMC has been somewhat of a volatility event, needless to say, and it probably, even though rates will not be changed, everybody's going to be hanging on every word. In fact, I saw where there's a betting market on how many times Powell is going to say, "I don't know," during the press conference. That right there indicates an awful lot of uncertainty in the markets. So it's a volatile day. It's been an excess volatile day for all three major indexes in the U.S. The S&P 500 and the Russell 2000, they typically move up about 40 or move about 40 basis points more than an average move on FOMC day. The Nasdaq 100, that which is comprised of technology stocks, which are more economically sensitive, it typically moves up or down 1.73% on FOMC day over the last 3 years. And that compares to an average move or up or down 1.14% on any day for the Nasdaq 100 over the same time period. And that's more than a 60 basis point move relative to the average move. And what we've seen is option traders haven't necessarily adjusted for that. And if you were a straddle buyer over the last 12 FOMC meetings, you actually would have made using the at the money index straddle, buying it on the close the day before FOMC and holding it through the close FOMC day. That's won 8 of the last 12 reports, and you would have racked up almost 1,000 points of profits. Index options have a very large notional value, but buying straddles in the index. And one last thought along those lines, because we do have the FOMC coming up this week, is typically option traders are short-sighted. And the last two index reactions were muted or less than average. And option buyers actually lost money on the last two. So we might get some cheap options in front of what could be a very explosive FOMC, not necessarily announcement, but press conference.
Right. Well, and it's interesting, Russell, because if we take a step back here for a moment and use this as a valuable teaching lesson, when you're looking at index at the money options, right, whether for straddle buyers, and when you're thinking about volatility, it's about the movement up or down, not necessarily the direction of the market. But that goes back to why the VIX doesn't necessarily have to be the fear gauge, because you're making a bet on the move to the up or down side. Am I correct in saying that?
Absolutely. And it's funny, some numbers that I've worked on that I haven't published yet. I've been looking at the volatility indexes on the Russell, the Nasdaq, and S&P 500 as a predictor of one-day price moves. You can adjust it to do that. And I found that the at-the-money straddle is a much better indicator to predict the next day's volatility than even 9-day VIX, because they have 9-day VIX, but definitely the 30-day volatility index is being adjusted. And I think that's because VIX is more focused on some downside. All three of those volatility indexes are a bit more focused on downside, whereas the at-the-money straddle is really focused on a magnitude of the next day's move, if you're buying that straddle or selling that straddle.
Right, and that's kind of the same concept that you use when you're looking at earnings as an example. You're looking at the anticipated move, whether it's the up or downside.
Yeah, I've been treating, especially now that we have daily expirations and we have 3 years of daily expirations to work with. I have a lot of data to play around with. And there are major economic numbers, FOMC, GDP, and the employment number, and CPI. Those are probably the four that I spend the most time paying attention to. They tend to have excess volatility, but I've been tracking the at-the-money straddles much like their earnings reports for the overall economy. And you can see the reactions out of the options. They're treating them kind of like an earnings report for the overall economy.
All right. Appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.